Okay, welcome Fakir. We're going to get going now. So we're going to be covering weighted average, we're going to be covering capital budgeting, and we're going to follow the similar format: 30 minutes theory, 60 minutes working through a question. The question we're going to cover is um, MAC 4862 CTA2 MAC question, the final exam of 2020 of last year. So let's go into it. When it comes to capital budgeting, the question you want to ask is, um, what is the importance of capital budgeting, or what is the purpose of capital budgeting? What you should note is that capital budgeting, the importance of capital budgeting is as simple as this. Every company wants to ensure the long-term sustainability of its company. Right? It wants to generate cash flows long into the future. In order to do so, it needs to continuously invest in new long-term investments, whether it is to maintain current product lines, whether it is to expand geographically, or whether it is to buy new machinery, or whether it is to expand by opening up a new product line or service. All of those are long-term investments, and it is in that instances where capital budgeting comes into play. So just keep that in mind. The importance is that every business needs to ensure its long-term sustainability. The way it ensures its long-term sustainability is by continuously making investments that runs over a long period of time. Now remember, a company can expand in two ways. It can expand organically, or it can expand through acquiring other companies. Now, capital budgeting deals with the expansion organically. So that is when ShopRite opens up more ShopRite stores, or when Pick n Pay opens up more Pick n Pay stores. That is expanding organically. Similarly, Coca-Cola can expand organically if they bring up a new flavor or a new line of cool drink. That is expanding organically. If you expand um, the opposite to organic, or unorganic, whatever it's called, but basically through mergers and acquisitions, then you fall into that topic, merger and acquisition. So just be aware you can expand in two ways: organically and unorganically. So here we're going to focus on capital budgeting. We dealt with what is the importance of capital budgeting. So just keep that in mind. Without continuously making the necessary investments, your company will come to an end. It will die out, because no product lasts forever. Just think about VW, for example. It ran that City Golf for how many years? But after a point in time, it realized it needed to put an end to the City Golf range and stop it. And what is the new City Golf range? It is the Polo. So just keep that in mind. To make sure your business runs forever and ever, you have to continuously invest. And that is the purpose, the importance of capital budgeting. So the next question then is, when do you know when you are in the domain of capital budgeting? It is as simple as this. If the question says, "Dear student, please advise management whether or not they should go ahead with a particular project," and if you look at the project is a long-term project, then you must know you're within the domain of capital budgeting. A long-term project, for financial management point of view, or for capital budgeting point of view, is more than 12 months. So whenever a project lasts for more than 12 months and you have to make a decision whether or not you are going to invest in that particular project, then you should you fall into the domain of capital budgeting. Now the question then comes, how do we advise management whether or not they should go ahead with an investment? In this case, we have various capital budgeting techniques. For our purposes, we have about 4 or 5 So number one, we have NPV, net present value. Number two, we have IRR, internal rate of return. Number three, we have the payback period. And number four, we have the discounted payback period. Number five, this is generally for CTA, most likely CTA2. You don't need to know all the nitty-gritties. You might just be aware of it. And that is the modified rate, the modified internal rate of return method. So those are the five methods available to us. So what you should know, the superior methods are the NPV method and the IRR method. Then the other methods would, so the discounted payback period and the payback period method, that are not superior methods. You should not base your decision on a payback or a discounted payback period method, but rather it can enhance your analysis. It serves there as a secondary analysis. So just be aware of that. In some questions, they'll ask you, and you must be aware, you must tell them that the payback period method or the discounted payback period method are not appropriate methods. It must rather be used as a, I can't remember, it kind of slipped my mind the wording they use, but you use it as an additional analysis, a sense check. Okay. Why I'm telling you this, in some exams, they're not going to ask you to do the calculation. They're going to give you calculations and you need to critically evaluate, critically analyze whether an investment decision was appropriate or not. And one of the first things we'll look at is which method did they use, which capital budgeting technique did they use. So why is NPV and IRR the superior methods? So all of these methods are cash flow based. So let's maybe start, why is the discounted payback period and the payback period not appropriate? So number one, the payback period method does not take the timing of cash flows into account. But like we know, the discount payback period does, so that eliminates that problem. But the biggest problem with the payback period and the discounted payback period method is that it only takes cash flows into account up until the point you made back your initial investment. It does not take all cash flows into account. It only takes cash flows into account up until the time when you have recovered your initial investment. So what makes NPV and IRR superior is that it's cash flows. It takes the timing of cash flows into account, and it takes all cash flows into account. So just be aware of that. There will be, in most cases, NPV and IRR will give you the same result. I'm not going to say the same answer, the same result. When I say result, I'm referring to whether you should accept or whether you should reject. So in most cases, IRR and NPV gives the same result. There are limited instances when there is a conflict in results, where NPV says accept, IRR says reject, or vice versa. What do you do then? In that case, you select the decision based on the NPV. The NPV is more superior. The reason being is it gives you a physical rand value. It gives you a physical dollar value, whereas IRR is a percentage. So although one of the advantages of IRR, many people understand IRR because it's a percentage. They compare the percentage to what their benchmark is. And if the IRR percentage is higher than their benchmark, they can accept or reject. Whereas NPV gives you a total rand value or a total dollar value. That does not tell them how it compares to their benchmark. So that is the difficulty of NPV, but it is more superior because it is giving you a physical rand value or dollar value. So the decision making is as follows. For NPV, if NPV is greater than 0, you accept the project. If NPV is less than 0, negative, then you reject the project. For IRR, if IRR is greater than WACC, you accept the project. If IRR is less than WACC, you reject the project. So once again, the importance of WACC, it helps you to evaluate a project. So just keep that in mind. Those are the basic decisions that we have to make. So before we move on to further details, let's recap. We covered what is the importance of what is the importance of capital budgeting. We said every business is required, or every business wants to ensure their long-term sustainability into the future. The only way they can do that is by continuously making the right investments, the right long-term investments. So the way you're going to do that is by applying capital budgeting techniques. When do you apply capital budgeting techniques? When a question asks you, or when you're in the real world and your manager asks you, or the CEO or the FD asks you to evaluate whether a project is viable or not. So just keep that in mind, okay? So whenever a project that is long, that generates cash flows over a period longer than 12 months, whenever someone asks you to evaluate such a project or make a decision on such a project, you must use capital budgeting. The next question we ask ourselves, so how do we evaluate? So we said there are capital budgeting techniques. There are 5, and the most common ones, or the superior ones we're going to make use of, is NPV and IRR. So just keep that in mind. You must know the payback period. They almost likely ask you here and there, but a 20-mark question is going to come from an NPV type of question. For our purposes, when you work at IRR, you must still do the NPV calculation, because the financial calculator, you will use a financial calculator to work out NPV, and then you just press a button on the financial calculator to get your IRR. So no matter which method, NPV or IRR, you're always going to be calculating NPV. So just keep that in mind. So that is the basics. Now let's move on to 2 further issues. Issue number 1 that we're going to cover is the issue of unequal useful lives, and issue number 2 is the issue of capital rationing. So unequal useful lives, what is that? In most cases, we're going to compare projects, project A versus project B. Remember, how do you evaluate 2 projects? You need to so you will use a capital budgeting technique, let's say NPV. You will do the NPV for project A, and you will do the NPV for project B. And then you will choose based on the highest NPV. Now you can only choose a project based on the highest NPV if the useful lives are the same. If both are 5 years, both are 3 years, both are 10 years, whatever. If the useful lives for both projects are exactly the same, it is only at that point where you are allowed, or where it makes sense for you to choose a project using NPV based on the highest NPV. Now the question is, how do you choose a question? How do you choose a project? How do you choose a project if the useful life is different? So if project 1 is, what did I say now? If project 1 is 3 years and project 2 is 5 years, you can't choose based on the high NPV, because the one is taking cash flows for 3 years and the other one is taking cash flows into account for 5 years. So obviously, because the one is taking cash flows for 3 years and the other one's taking cash flows for 5 years, the one with the 5 years of cash flows will obviously, or not obviously, but will most likely be higher. So therefore, we need to find another way in order to evaluate a project such that you compare apples with apples. So there are 2 techniques available. Technique number one, it is the annual equivalent annuity or equivalent annual annuity. Technique number two is the replacement chain. Don't worry with the replacement chain, just use the equivalent annual annuity. So, for example, you need to decide whether you should, your manager or the FD asks you to decide or to help them decide whether they should go with project A or project B. Project A has a 5-year useful life, project B has a 3-year useful life. For both projects, you will still calculate the NPV. But at this point, you can't decide based on NPV. We need to do something, we have to go one step further. We need to convert those NPVs so that they are equivalent to each other. So like I said, one of the methods, the equivalent annual annuity. The way we get this into an equivalent annual annuity, but let me first tell you what is the equivalent annual annuity. The equivalent annual annuity tells you what is the NPV generated per annum. So now you're comparing apples with apples because both numbers is on a per annum basis. So the way you get the equivalent annual annuity, it is basically EAA, equivalent annual annuity, equals NPV divided by the present value annuity factor. Present value annuity factor is, that table in the what we call that, the present value tables that we know about. You will just look year 3 and you look under the WACC number and you get your present value annuity factor. Not going to do detail about this. This is in our course. So when we come to that in the course, you will have it. I just wanted you to be aware of just seeing the bigger picture. Next is the capital rationing. What is capital rationing? Capital rationing is where a company has a limit on the amount of on the rand value that you can spend on investments. And this makes sense. Every company has a budget. So every company would put a budget in place for capital investments. So whenever there's a budget, you fall into the domain of capital rationing. However, there's 2 conditions that must hold. Condition number 1, as we discussed, there is a budget or there's a limit on how much you can spend. And then condition number 2, if you add up the initial cost of all projects that are viable, if that initial cost exceeds your budget, it is only at that point where capital budgeting comes into play. So for example, you have 5 projects, right? Or let's say you have 3 projects, 100,000, 200,000, 300,000. So the cost of the 3 projects, 100, 200, 300, total cost is 600,000 rand. Based on the budget, you only have 500,000. So that means you can't invest in every single project. You have to decide because you only have a limit of 500,000. So in that case, both conditions hold. Number 1, there was a budget. Number 2, the initial investment or the cost of the initial investment for all projects that are viable exceeds the budget. That is when capital rationing comes into play. When capital rationing comes into play, what you have to do is use the technique known as, what's called now, present value, I cannot remember the name, but just was on my tongue. Anyway, I cannot remember the name. I'll come to me as we go through the thing. But basically the way you calculate it is by saying, whatever this thing is, divide equals present value divided by initial costs. Present value divided by initial cost. It's on my mind. But I'll come to the name now. I cannot remember the name. So just keep in mind, when capital rationing is applicable, we use this formula, and it is whatever this thing is equals present value divided by initial investment. So just that in mind. It gives you a ranking, and you select projects based on the highest rank. So that's all I wanted to cover for capital budgeting, just to see the big picture. I'm going to do a recap now. Then I'll ask you if you have any questions, and then we'll go on to the question paper. So just to recap, we covered what is the importance, or what is the purpose of capital budgeting. And once again, all companies wants to ensure that they operate into the future, into the long term, sustainably. The way to do that is to continuously invest in projects that are viable. So that is the importance of capital budgeting. If you do not do the continuous investments, you will run out of business. Let's take a simple example. Think about an Uber driver. They buy a car. That car is a capital investment, and they are generating revenue through making trips. Now, if they do not replace that vehicle, firstly, Uber has rules. You need it needs to be 5 years old, but let's assume there was no rules, and you just continue using that vehicle. After 20 years, that car is probably finished, and no one's going to want to drive in your car that looks 20 years old. So if you do not make the necessary investment, you're going to end up losing business. You're going to become irrelevant. And if you can see that, that is the basic principle of the importance of capital budgeting. You have to continuously invest in order to remain relevant, in order to ensure your company operates long-term in a sustainable manner. When do you know when capital budgeting is applicable? When they ask you to advise or to evaluate or to make a decision. More important, when you have to decide whether or not if a project is viable. The moment you see that, you must know, okay, this is a project that generates cash flows over a period longer than 12 months, and I have to decide whether I should go ahead with this project or not. Capital budgeting. How do you decide? We use capital budgeting techniques. We said there's 5, but the main ones is NPV and IRR. If they don't say anything, just use NPV. Okay. If they don't tell you IRR, don't do IRR. If they don't tell you discounted payback period, don't do discounted payback period. If they don't tell you to do if they don't do payback period, don't do payback period. If they don't do anything, you use NPV. Okay. If they tell you NPV, it means you must use NPV. Okay. So just keep that in mind. Then we said further issues. It is unequal lives and capital rationing. The moment you're comparing projects that have unequal lives, then you have to make them comparable. And one technique is known as the equivalent annual annuity technique. And in order to make them comparable, that brings them into an NPV per annum. The one with the highest NPV per annum is selected as the project. Remember, there's only quantitative, right? There's still qualitative factors you have to consider, but they always ask you quantitative, then they separately ask you qualitative. And then capital rationing, we will use capital rationing when 2 conditions hold. There's a budget, and all projects that are viable, the cost of those exceed the budget. And then we need to rank them using a technique. The technique is whatever the technique is equals present value divided by initial investment. Okay, so I'm going to stop there. Before we move on, do you have any questions? I see there's Nasira. Welcome, Nasira. Anyone who have questions? Faid, Fakir, Ryan, Nasira, do you have questions?
No questions.
No.
I didn't hear you say, Ryan.
No, nothing on my side.
Nothing on your side, Fakir?
No, I'm all good.
Nasira? Okay.
Nothing from my side.
Okay, cool. So now we're going to go on to an exam question. So this is the real deal, okay? This is CTA 2. MAC 4862, 2020 final exam. I'm going to share the question with you on my screen, and then you can read it. I'm going to give you the one page that you need to read, and then we're going to cover it. I'll use Excel. I'll read it with you so we can learn how to read. We're not going to read the full scenario because we're going to sit here till 9 o'clock, and we don't want to sit here till 9 o'clock. So we're only going to read 2 pages, just the background information, just to get a sense of the company, and then we're going to read the section regarding or relating to the capital budgeting. For your purpose, I only want you to read the capital budgeting part, just so that you are familiar with it before I read it with you. So I'm going to share it, and then I'm going to give you 5 minutes to read it. Okay. Just give me 1 minute to just sort out something quickly. I'll be back now. Something on the sharing thing quickly. Can you see it? Can you see the question?
Yeah, I can see.
Okay, so it's question
Yes.
1. Read. I'm going to make it smaller now so I can bring the whole page. So just this new bagging plant. Okay, so new bagging plant, take 5 minutes to read that, and then we will go through it.
Zoom the question in, I can't see.
Okay. I can't hear you saying?
Zoom it a little, man. I can't see the small words. Zoom the question in.
Better?
Yeah, so it's fine.
So Nasreen, just read this one page. This is the Mac 20, the CTA2 Mac question paper of 2020. Just read this paper. I'll give you 3 more minutes, and then I'll go through it with you guys, and we'll tackle this question. Okay, are you guys ready? Can we go through it? I'm going to start at the top of the question just to get some background and just to give you a sense of how you should read a question. And hopefully by the time when you use your reading time, you actually have a better understanding of the question. Remember, from now till your final exam, although you have many checkpoints, so for the CTA guys, you have many checkpoints, which is your tests. But ultimately, it comes down to that final exam. You need to do well in your test in order to make the final exam, but that's ultimately the final exam that will help you to pass or not. And so throughout the year, rather struggle now than struggle in the exam. So practice now to read a question thoroughly and to understand the question. Rather work through 10, 20% of a question, but make sure you work through it properly. It's going to stand you in better, it's going to help you way more than rushing through a question paper. So try to make sure you can make sense of each paragraph. Remember, making sense means identifying whether it's relevant or irrelevant. Not everything is relevant. So as we're going to go through this, I'm going to try to show you how to read a question. And so I'm going to start with this page. I'm only going to read this page and the next page, because that's all we need. We don't really need this page just to give us an idea of the question. So let's start. They tell you to ignore value-added tax, dividends tax, and any possible impact of Section 8 of the Income Tax Act. Okay, so that is recoupment stuff. So why that's important is because in, what was it now? Maybe if there's sale of assets and so forth, Section 8 comes into play. So they're just telling you to ignore those type of stuff. So the background and strategy, part A. The cement company and Productions, CPP, was established in Pretoria in 1945 by the Van Wyk family and was South Africa's first cement plant. CCP is a resilient organization that has adapted and flourished through changing economic, technological, and political circumstances, becoming a leading provider of quality cement. CCP has expanded internationally and is operated in various countries, specifically in Africa. Cement, okay, before we go on, so there you can see just a background information, 1945, that's cool. I think what is important over here is that they operating internationally. So not just in South Africa, and mainly operating in the rest of Africa. So just be aware of that. That will help you with obviously with strategy related questions. Remember, when you're dealing with strategy related questions, the tools that you would use is or are SWOT analysis, PESTEL, and Porter's 5 forces. Remember, PESTEL is used on the macro environment. So the external macro environment. What does that mean? That is where the company is operating nationally, internationally. So you use PESTEL to analyze the national and international environments that the company operates in. Then we have Porter's 5 forces. Porter's 5 forces is also used for the macro environment, but the internal macro environment. That is, or maybe put it this way, the micro environment, the external micro environment. So PESTEL is used for the external macro environment. That refers to the countries in which the company is operating in. So nationally, internationally. Porter's 5 forces is used for the external micro environment. Micro environment referring to the industry or industries in which the company is operating in. And then you use the SWOT analysis. The SWOT is formed based on Porter's, based on PESTEL. Okay, so just keep that in mind. So international, you will use PESTEL to analyze the international environments. So now we go on. Cement manufacturing is a complex process that begins with grinding the required raw materials, which primarily includes limestone and clay, to a fine powder. We all know what cement looks like. This powder is fed into molds for mixing and is then heated in large furnaces. The modules formed from this heating process is called clinker. The clinker is cooled by a rotatory cooler and is mixed with water and other minerals in very specific proportions to produce cement. CCP's strategy is aimed at prioritizing the financial capital of the group. The board's main concern is to maximize shareholder wealth. Okay, so that is obviously, on a traditional sense, it is to maximize shareholder wealth. That is why they're not so great anymore. They don't look at things beyond shareholder wealth. But that is their thing, so it's financial capital. So that is giving you a background on strategy over here. Remember, in Mac, you will cover towards the end of the year. I think the principles um, of integrated reporting and so forth. Actually, you learn it in financial reporting, so it will play a role that time. So we won't cover that now. Okay, so let's look at the letter to the from the CEO. So the CEO, Mr. Van Wyk, annually writes a letter to the shareholders of CCP. Below are extracts from the 2020 letter. The COVID-19 pandemic really hit the construction industry hard, and CCP was no exception. The prolonged lockdown announced by government impacted production, liquidity, human capital, stock levels, and overall morale. CCP was fortunate to have no positive cases and, more importantly, no deaths to date. At present, the market is growing but very slowly. Consumers are hesitant to invest in the construction industry as uncertainty remains with the pandemic and the economic impact thereof. The prolonged incubation period of projects and increased competition has led to a lower profit and liquidity constraints for CCP. The board has planned initiatives to turn around the liquidity and performance of CCP, which includes insourcing the bagging of cement, various cost-cutting initiatives, and the sourcing of skilled personnel and new machinery to optimize current processes. Okay, so they're just giving you what is the intentions. So now we come to part C, new bagging plant. So now we're going to read this a bit carefully. And remember, when it comes to capital budgeting, and there's 5 basic principles relating to capital budgeting. Number 1, we always focused on future cash flows. Number 2, in no particular order. Number 2, the timing of cash flows is of extreme importance. Number 3, we take opportunity costs into account. Number 4, all cash flows have to be after tax. And number 5, we do not take financing income and expenses into account. So what are the 5 principles? We focused on future differential cash flows. So future meaning flows, cash flows that must still take place, not cash flows that they have already incurred. Cash flow meaning must not be non-cash flow items, so no like depreciation and impairment and so forth. It must only be cash flow amounts. So whenever an amount is given to you and it includes non-cash flows, you must remove the non-cash flows. Differential or relevant means that an amount is only included as a result of this decision. So you only take amounts that would take place as a result of going ahead with a project or as a result of not going ahead with a project. So just keep that in mind. So that's number 1, future differential cash flows. All cash flows must be after tax. That is why in the NPV calculation, you have a line item called tax. The timing of cash flows is of extreme importance. Remember, we're looking into the future. We're estimating cash flows into the future, and then we are discounting them to the present value. So if something was happening in year 3, but you put it into year 2, you are mixing up the timing, and that can have a significant impact in the value. So just keep that in mind. They're always going to test the timing of cash flows, whether you know it or not. So the timing of cash flows is important. That was number 3. Number 4, take into account opportunity costs. What is opportunity cost? The best alternative for gone. You decided to drive Uber as opposed to sell your car. So because you are driving Uber, you're using your car to drive Uber, you have foregone the opportunity to sell your car now. And then number 5, ignore financing costs. So if they give you interest expense, you do not include interest expense in your NPV calculation. The reason is because financing is taken into account in your WACC calculation. So the WACC rate already factors in financing. So if you include financing as well, interest expense, you'll be double counting. So just keep that in mind. So when we read through this now, try to see which of those 5 principles it impacts. So they say the board of CCP is considering insourcing the bagging of cement. Currently, the bagging of cement into 500 kilogram bags are outsourced to Bags for Africa. Bags for Africa has a contract with CCP to bag 20 million bags per year at a fixed rate of 3 Rand per bag for the duration of the contract. Any bagging performed by Bags for Africa above the contractual volume is charged at a rate of 3.75 per bag. The Chief Financial Officer, Mrs. Kobodi, was tasked to investigate the insourcing initiative and presented the following to the board. The contract was granted to Bags for Africa per a suggestion from Mrs. Komotso, the Financial Director of CCP. The Financial Director of CCP, as Mr. Manteshi, the CEO of Bags for Africa, is an old friend of hers. Since Mr. Manteshi is such a respectable businessman, no formal tender process was followed. Okay, so that you can discuss from a governance point of view, but we're not worried about that now. The contract with Bags for Africa expires on 30th September 2024 with a penalty clause of 1 million Rand should it be terminated by CCP prior to the expiry date. So we need to see where we are. Remember, I told you in the WACC lesson that in financial management, we must always have a reference point. And particularly, we must have a reference point for WACC, capital budgeting, and valuations. So we need to now see what is our reference point, what date are we working with, because we can see there is a penalty clause if we must cancel early. They say bullet point number 3, Bags for Africa has capacity for 40 million bags per year, of which 30 million bags are allocated to CCP. Should CCP decide to insource the bagging of cement, 5 new bagging machines will be required, each costing 13 million Rand. Installation will cost 180,000 Rand per machine, and 100,000 Rand will be payable should staff require training on the use of the machine. The machines will be ready for use on 1 October 2020. So that is most likely the reference point, and can be sold for 1.3 million per machine at the end of 4 years. So let's stop there. In bullet point number 4, if we were to do the insourcing, we need 5 machines at 13 million Rand each, and also an installation cost of 180,000 Rand per machine. So remember, that is your initial investment. You need that immediately. Without that, you can't do any bagging. So you need that now in order to bag going forward. So you can see our reference point is most likely 1 October 2020 or 30th September 2020. 30th September, 1 October, same thing. And then they talk about 100,000 Rand, but that 100,000 Rand will only be incurred if we need training. If we don't need training, then 100,000 Rand will not be incurred. Remember, in financial management, when numbers are given to you and you do not use it, you must still tell them why you're not using it. Don't just leave it blank, okay? And then they also tell you at the end of the useful life, at the end of 4 years, we will be able to sell the machine for 1.3 million. They say the new machines will be depreciated over 4 years, and SARS will allow a 25% capital allowance per year. Each machine Each of the new machines have the capacity to bag 4 million bags per year. Any bag requirements in addition to the available capacity will be outsourced to BFA at $375 per bag. So see, each machine can bag 4 million bags. There's 5 machines. So all 5 machines will be able to allow 20 million bags per annum. The moment CCP requires more than 20 million bags, that excess above 20 million will have to be outsourced to Bags for Africa. CCP has the capacity to produce 12 million tons. 1 ton equal 1,000 kilograms. So 12 million tons, in other words, they can produce 24 million bags with that 12 tons. Because remember, each bag 500 kgs, 1 ton 1,000 kgs. So 2 bags per ton. So effectively, if they had to bag all the tons, they can bag a maximum of 24 million bags. However, let's assume they go to full capacity. So they produce all 12 million tons. That means they will need 24 million bags. In that case, 20 million bags will be done internally and 4 million bags will have to be outsourced. Let's read on. Where did I stop? Per annum. Mrs. Gobodi estimates that CCP will produce 10 million tons in 2021. So in 2021, they're going to produce 10 million tons. That is equivalent to 20 million bags. So we're reaching full capacity in terms of the bagging machines. Then in 2021, with a 5% increase in production each year thereafter for the next 3 years. What's important, so each year we can only bag 20 million bags. So anything above 20 million bags will have to be outsourced to that other place, okay? Will have to be outsourced to, what's this place's name now? To CCP. So just be aware of that. So in 2021, there will be no outsourcing, but 2022, 2023, and 2024, there will be outsourcing. Next paragraph, a location for the new plant has already been identified. The old staff cafeteria can be refurbished at a cost of 3 million rand. Due to the diversity of the dietary requirements, drop in production output, losses incurred, and theft, CCP has decided to close the cafeteria. Okay, so just keep that in mind. So 3 million rand, that is a refurbishment cost. That will happen immediately. Without refurbishing, there's no place for the bagging machines. So in order to have a place for the bagging machines now, we'll have to incur the 3 million rand now. Okay. So due to the diversity, okay, CCP has decided to close the cafeteria. The cafeteria has made on average a cash loss of 300,000 rand per annum. So because we're closing the cafeteria, so we're no longer making a 300,000 rand loss. So you must bring that into your capital budgeting, into your NPV calculation by bringing a positive 300,000 rand. Because you're no longer losing a 300,000 rand as a result of closing the cafeteria. If you are making a profit of 300,000, then you'd have to bring in a negative 300,000 rand. The next bullet point, the plant requires 2 skilled employees per machine. Remember, we have 5 machines, so we need 10 skilled employees at a fixed salary of 25,000 rand per month for each employee. So to get the employee cost, it will be 2 employees per machine times 5 machines. So 2 times 5 multiplied by 25,000 rand per month. But because the NPV calculation is on an annual basis, we multiply it by 12. Okay. where was I now? 25,000 Rand per month for each employee in 2021. Ms. Kobodi approached some of BFA's employees and ascertained that they would be willing to resign from BFA and join the workforce of CCP on condition that their salaries increase by 6% per year after 2021. So therefore, from 2022, you increase by 6%. It is very likely that CCP will hire these employees, as Mrs. Kobodi is of the opinion that since these employees are familiar with the bagging function, they will not require training on the usage of the machine. All other labor required would be absorbed within the current workforce of CCP. So as you can see, they're going to hire people from BFA, and therefore they will not incur that 100,000 Rand training costs. So you must still have a line item in your NPV calculation, training costs. You must show 0, and then you need to put a reason as to why you're showing 0. Next, the paper bags to be utilized for the bagging of the cement can be purchased locally at R1.50 per bag in 2021, with a 10% increase year on year. While these bags are not recyclable, they are sustainably less expensive, and CCP is of the opinion that customers are unlikely to be interested in the environmental friendliness of the cement bags. Here you can see from a qualitative point of view, they are shallow thinkers, right? So they're only worried about money, profits. Although lots of research, like lots and lots of research have shown and have proven that companies that looks at everything, like they call it the triple bottom line, they are more successful than companies that just purely focus on profit. And like for me, when I was in working at companies, and I worked at asset management companies, then it is very clear that asset managers are kind of forced, because their clients want to invest in companies that have that take ECG very important, the environment very important. So you can see this is limited thinking. They're just thinking now. They're not really thinking very long term. So they may survive now, but the moment customers and people that invest into their company sees otherwise, they will start losing out. So from a qualitative point of view, that's an important point to note. Okay, because here you can see that they're not worried about environmental friendliness, and also above they make mention, they just worried about maximizing shareholder wealth. They're not considered about the environment. They're not considered about the communities in which they operate in. So from a qualitative point of view, be on the lookout for those type of things. Next bullet point, overheads and other administrative expenses will increase by 600,000 Rand per annum in 2021 as a result of the insourcing, with an annual increase of 5%. Okay, remember, we were looking at future differential cash flows. Overheads is a cash flow. They're talking about from 2021, which is in the future. Is it relevant? Is it differential? Yes. They will say, they said overheads and other administrative expenses will increase by 600. So as a result of this project, overhead is increasing. If it was not for this project, overheads would not have increased. So that is an example of a relevant or a differential cash flow. Initial working capital of 4 million Rand is required and would be recouped at the end of 2024. Just be aware, they could have just said initial working capital of 4 million Rand is required, full stop. You must know that when you invest working capital initially, at the end of the project, you will get the working capital back. You will recoup it. So they did not have to tell you that it would be recouped. Okay, the last paragraph, the last bullet point. Mrs. Kobodi indicated that the project cash flows relating to the insourcing of the bagging function should be discounted at 10%, as this is the cost of the loan that would finance the machines. For those of you who were on my class or on the lesson on Tuesday, when we covered WACC, I made mention that why the WACC rate. And I told you that there will come circumstances where they ask you which rate to use. Do you use the WACC rate to discount a long-term investment? Or do you use the rate that was obtained in the specific finance? Here's an example. The CFO, which is quite shocking, is the CFO. Yes. The CFO is saying you must use the specific finance. Now remember, when we dealing with capital budgeting, the discount rate is always the WACC rate. It is not the rate obtained in the specific finance. Why? Because the WACC rate represents the general cost of finance to the company. The general cost of finance to the company. So over the long term, the general cost of finance to the company will equal to the WACC rate. Whether or not, in some cases, they will fund a project solely through equity. In other cases, like in this case, they will fund a project solely through debt. But over the long term, they're going to ensure that their funding is in the right mix of debt and equity, in the right target capital structure mix. So that is why we will always use the WACC rate. So be aware, there's a typical question that will take place in a CTA 2 level, not so much CTA 1, but you never know. So just be aware of that. She is wrong in saying use 10% because 10% is the specific finance for this particular project. We have to use the rate of the general funding of the business, which is the WACC rate. Just to note, there is an instance when you do use the specific finance, but that is, I don't think that forms part of the psych syllabus for us, so I'm not going to go into those details. If you want to read about it, if you have the financial management textbook of Carlos Correa, he gives a whole explanation over there of where you do make use of the specific loan finance, but in general, you always use the WACC rate. So let's have a look. I'm going to switch over now to Excel. I do tend to forget to share my Excel, so just remind me when I switch between this and when I switch between the scenario and Excel, just remind me if I'm not on Excel. But before I go to Excel, I'm just going to go to the required, so you can read the required and see how it makes sense. If you look at part C, can you see the required? Hello?
Yes. Yeah, I can see.
So C1. C1 says, based on quantitative analysis as at 30th September 2020. Remember, I said for capital budgeting, WACC, and valuations, you always need a reference point. Reference point mean a date. Without a date, how would you know when must the present value be? So remember, you need a date. So the date here is 30th September 2020. Remember, our contract with Bags for Africa is 2024. So if we go ahead with this, we're going to have an early termination, and hence we will have to pay that penalty. Okay. Now they say advise the board of CCP whether it would be feasible for them to insource the bagging function for a period of 4 years. You see the word advise. You know it is the bagging, to insource the bagging function. That is a project, an investment project that is for a period of 4 years. That is a long-term investment project. You need to advise the board on the feasibility of a long-term investment project. That tells you you are dealing with capital budgeting. So now you will make use of the NPV. They didn't tell you which method, so you just use NPV. So they say round values to the nearest rand thousands. Okay, so just be aware of that. Remember, quantitative analysis, 20 marks. So let's go and jump straight into it. So I want you to make sure you understand the required. Advise management on the feasibility of insourcing the bagging function for a 4-year period. The insource of a bagging function is an investment project. It is a 4-year investment project. Any project that is longer than 12 months is considered a long-term investment. And hence you need to advise on a long-term, you need to advise on the viability or the feasibility of a long-term investment project. So that means you are in the domain of capital budgeting. You must think about the capital budgeting techniques. They never told you which one to use. So therefore, you use NPV because that is the most superior capital budgeting technique. So make sure you understand the required. If you don't understand the required, no matter what you do, you're doing everything by chance. And remember, I don't know how good you are at gambling, but yeah. So let's move on to the question. So here's Excel. Can you see Excel?
Yes.
Okay. So here is Excel. I'm going to have capital budgeting questions. So this is C1 capital budgeting. The way you set up a NPV question, I'll show you. I always have these two columns. Column number 1, details. Column number 2, year 0. Okay, so details and year 0. Then include the next is going to be the length of the project. So it's a 4-year project. So I have year 1, year 2, year 3, year 4. So in effect, it's going to be 2 plus, so it's 2 columns plus the length of the project. Okay. So just be aware of that. And sometimes you'll have an extra column if there's a tax lag. If there's a tax lag, then you'll have an extra column. But it's not in this case. So how you set it up? Details, year 0, and then the number of years of the project. So there's 4 years. To make it understandable, you put in the reference date, 30th September 2020, 30th September 2021. And then I'm just going to drag this and we'll go all the way to 2024. So we want to format this. I like myself formatted. Okay. Okay. So here it's formatted. Okay, so there we have it. Remember I said the 5 principles of capital budgeting, future differential cash flows. What was the next one? Future differential cash flows, after tax, timing of cash flows, opportunity costs, and do not include financing costs. Now on the timing of cash flows, this is how timing of cash flows get tested. Each column over here, so year 1, year 2, year 3, year 4, represents the end of the year. So year 1 represents the end of year 1. Year 2 represents the end of year 2. Year 3 represents the end of year 3. And year 4 represents the end of year 4. Okay? So the moment something takes place at the beginning of year 3, you cannot put it into year 3 because year 3 represents the end of year 3. So where do you put it? You'll put it into year 2 because the end of year 2 is the same as the beginning of year 3. Now remember, a fundamental principle is the timing of cash flows. So if you put something in the wrong column, you're not just going to get it wrong. You're going to get minus. Okay, so they're going to deduct -1, -2, -3, -4, -5, depending how the examiner feels. I don't know how, yeah, so it depends how they feel. They will minus. They're definitely going to minus. How much they're going to minus, I don't know. But it won't be more than 5. But I mean, -5 is quite a bit. It separates 100% from 99%. It separates an A from a B. It separates a pass from a fail. So just keep that in mind. The timing of cash flows is important. So each column represents the end of the year. If something happens at the beginning of that particular year, you put it into the previous column, because the previous column represents the beginning of your column you're busy with. So just be aware of that. Okay, so please, timing of cash flows is extremely important. So let's get a move on. I'm going to switch between, I think if I just switch, you should be able to see. So I'm going to switch now. Just tell me if you do see it. You see the scenario. Yes. Okay, cool. Now I'm going to read again. I'm going to start off with bullet point number 2. Okay. So they say the contract with BFA expires on 30th September 2024 with a penalty clause of 1 million rand should it be terminated by CCP prior to the expiry date. So remember, so I'm going to make this clear. So the decision over here is we're assuming we are insourcing. Okay, so that is what this decision is about. Insourcing the bagging machines. Insourcing the bagging machines. So we're assuming that we are insourcing the bagging machines. So we take into account all costs and all revenue as a result of insourcing the bagging machine. So when you do this question, you tell yourself, we are insourcing bagging machines. So what costs and what revenues are we earning and incurring? Okay. So as a result of insourcing the bagging machines, before the contract comes to an end, there's going to be a termination penalty. A termination penalty. The termination penalty will have to be paid immediately. So therefore, immediately, now, currently. So whenever you see the word current, now, immediately, we're in year 0. Okay, so we're going to incur that. It's an outflow, so it's 1 million rand. I'm just going to use full rand figures. Remember, you won't get the marks because they told us to use rand thousands. So you use rand thousands. It's going to take extra time now. So I'm just going to work with full numbers. So we incurred that. Next bullet point. BFA has a capacity of 40 million bags per year, of which 30 million bags are allocated to CCP. Should CCP decide to insource the bagging of cement, 5 new bagging machines will be required, each costing 13 million rand. Installation cost of 180 per machine and 100,000 rand is payable should staff require the use, the training on the use of the machine. So here we're going to have bagging machines. Once again, the bagging machine, the cost of bagging machines need to be incurred now. If we don't incur it now, we can't bag anything, so we need it immediately. We need it at the beginning of year 1. To have it at the beginning of year 1, we can't put it into the column of year 1 because the column of year 1 represents the end of year 1. So therefore, we put it into year 0. So it's equal to minus, which is a cost, and it is 5 machines times 13 million rand. Then we're going to have the installation. Once again, you need to install the machines immediately. So it is 180,000 per machine times 5 machines, which is 900,000. And in that paragraph, they spoke about staff training. Before you can use the machines, you'll have to incur staff training. So the staff training costs would be incurred immediately. But remember, we're not going to incur it because we're hiring skilled labor from BFA. So the staff training, had there been staff training, we'd have incurred 100,000 Rand in year 0, because you need to incur the training immediately for staff to operate the machines. But because there's nothing, we show 0, and we go leave a reason. We will say hiring skilled labor and hence no training required. So now they know why you're putting in 0. They don't assume that you're putting in 0 because you did not know what you were doing, but they know you're putting in 0 because of that reason on the side. Remember, in financial management, if there's a number and you're not using, and you could have used it, you must tell them why you are not using it. Don't leave it blank. And when you don't use it, put a reason. Next paragraph. Where was I now? Paragraph. Okay. The new machines will be depreciated over 4 years, and SARS will allow a 25% capital allowance per year. Okay, we will deal with that when we come to the tax calculation. In an exam, highlight that because you didn't use it yet. Or put an asterisk, not highlight, because you already highlighted as you went through. Put an asterisk next to it because you have not yet used it and you're going to go through the rest of the question. You don't want to forget about it. So just put an asterisk next to that point and just move on. Each of the new machines have the capacity to bag 4 million bags per year. Any bagging requirements in addition to the available capacity will be outsourced to BFA at 3.75 per bag. CCP has the capacity to produce 12 million tons of cement per annum. Mrs. Kabodi estimates that CCP will produce 10 million tons in 2021, with a 5% increase in production in each year thereafter for the next 3 years. Remember, as I mentioned in the previous, we want to put the answer right on top, no workings when the examiner sees. So any workings that will have an impact on the NPV calculation, show it separately. So I will show my workings over here. This is like a new page to me. So this is like a new page to me. Here's my workings. And I'm going to say working 1. So here's my working 1. And now I'm going to do the calculation. So I'm going to say capacity tons. Here's year 1, year 2, year 3, year 4. So I'm going to take this, put it here. Details. So capacity tons, 12 million. Okay. I'm going to say capacity bags. Remember, our capacity of bags is 20 million. 1, 2, 3, 1, 2, 3. Now we can see what is the requirement. Okay. Required bags. we know the required bags is equal to 10 million tons. 10 million tons times 2. Remember, 2 bags per ton. That's what is required. Thereafter, it is going to increase by 5%. So I'm going to say that multiplied by 1.05, or we rather do it like this, 1 plus 5%. And I can just pull this formula all across. So I'll have either a surplus or I would have a shortfall. In the event that I have a shortfall, I would then have to outsource the shortfall to BFA at a cost of 375 per bag. So now I'm going to say available or capacity minus required, nothing in year 1, and there is a shortfall in year 2 onwards, so I need to work that out. Okay, outsourced at 375. So now I'll just say shortfall multiplied by 375 per bag. Obviously 0 times anything is 0. And that is going to be my outsourced costs. So here I'll have additional bags outsourced. I will go fetch it from my calculation and I'll just drag it across. And then I'll just tell them I got that from working 1. What I want you to be aware of is that although the capacity is 12 million tons, 12 million tons times 2, because remember, 1 ton is 1,000 kilograms. In each bag is 500 kilograms. So therefore, for every ton, you get 2 bags. So some students would have done this. They would have said 12 million times 2 gives me 24 million bags. So in year 4, I only need 23 million, so there's no shortfall. So just be aware, although your capacity is 12 million tons, which is equivalent to 24 million bags, your machines can only bag 20 million. So anything beyond 20 million that your machines can actually bag needs to be outsourced to BFA. So just be aware of that. Okay. Another important to note, let's look at year 4 over here. Let's say the required bags based on our 5% increase ended up being 25 million. Remember, you'd have to limit it to 24 million because your full capacity is 24 million. So be on the lookout for those kind of small things. Okay. So don't just run with formulas. Do sense checks to make sure that, like I did, the 23 million is in our 24 million bags, because 12 million times 2 gives you 24 million bags. We require 23 million. But so that means we have the capacity to produce cement that is equivalent to 23 million bags. However, of the 23 million bags, we can only bag 20 million, and the remaining would have to be outsourced, and we can outsource it to BFA at a cost of 375 per bag. Before I move on, do you have any questions on that, or do you get what I'm saying over there? Fakir, I can see your name first. Any questions?
Nah, Uncle. No
No
questions.
questions.
Ryan,
All good.
do you follow?
Yeah.
Nasira?
No questions.
No questions. Okay. Nasreen, okay, I got your thumbs up. Faid,
No questions.
okay. So just be aware, important, there's two capacities over here. The actual making of cement and then the bagging of the cement. The making of the cement is equivalent to 24 million bags. But how many of those 24 million can you bag yourself? Only 20 million. So when you look at the production of cement, you need to first check that it does not exceed the 24 million capacity. Then you have a look at, okay, it is within the 24 million capacity, so I'm good over there. I can produce all 23 million. But how much of the 23 million can I bag myself? Only 20 and the rest. So there's a double layer of capacity constraint. So just be aware of that. Next.
Faiz, just a quick question before you go further.
Yeah.
That capacity tons there, the 12 million, is that at full capacity or is it at a lower capacity?
I'm
not sure now in the question.
Capacity. They just said capacity. Where did I see that now? Is it 12 million? They just said has the capacity to produce. They didn't say whether it is operational or whether it is full capacity, nor did they give us an operational capacity percentage. So you can just assume that the full thing is possible.
So say for example they do give two different capacities, operational capacity or full capacity. What do we actually use? Do we go with the full capacity or only at operational, for example?
So remember, there can be three levels of capacity over here. So number one, full capacity. Full capacity is where the machine run non-stop without any maintenance. Okay. Normal capacity or operational capacity, that is where the machine runs at full capacity, but taking into account normal stoppages such as cleaning the machine, putting in the new, like resetting and all of those type of stuff. And then you get a capacity that they want to operate at. So when you look at a question, you always make use of operational capacity or normal capacity. The full capacity based on normal stoppages. Because remember, a printer, when you buy a printer, they'll tell you the full capacity. But there is times when the thing needs to stop, rest, this and that. They don't take that into account. So when you look at the printer, you must say, okay, the full capacity is 25,000 pages, but I know the printer we need to stop it to put in new paper, change the ink, do this, do that. So actually, per day, we can only do 20,000 pages as opposed to 25. So you'll look at the 20,000 because that is what can be realistically achieved. So you always use operational or normal capacity when doing this type of a calculation. Does that answer your question?
Yeah, perfect. Yes.
Okay. Now I'm going to go on. We did the 12 times, we did the 5% increase, okay? A location for the new plant has already been identified. The old staff cafeteria can be refurbished at a cost of 3 million. We read through that. So we said the refurbishment will have to be taken into account. So we're going to have refurbish costs 3 million. Remember, you're refurbishing the cafeteria to place the bagging machines. The bagging machines need to be ready in order to be used. So the cafeteria area needs to be refurbished. So therefore, the refurbishment cost is being incurred immediately. So you must be able to pick up when something takes place if they don't tell you. Okay. Then we have a lost savings. The lost savings, when the cafeteria was running, we incurred a loss of 300,000 Rand per annum. Now that the cafeteria is no longer running, we're no longer incurring that 300,000 Rand, so we're actually making a savings. So therefore, we include the 300,000 Rand. Okay. Where were we now? Okay, next bullet point. The new plant requires 2 skilled labor per machine at a fixed salary. Okay, so this is that salary calculation. Remember, we said, so here we'll put in here labor costs, skilled labor. You incur the labor, you don't pay them upfront. You're paying them per month. Remember, in financial management, we assume that cash flows either happen at the beginning or at the end. So in reality, just think about this, the Uber driver. He don't just make all his trips or all his money at the end of the year. He makes it throughout the year. But now if you're going to do a capital budgeting question per day or per month for 10 years, your Excel sheet is going to run forever, right? So to make it more reasonable, we work out our capital budgeting on an annual basis. So although cash flows happen throughout the year, we assume cash flow that happen throughout the year takes place at the end of the year. It is not 100% accurate, but it still gives you the correct result, because you are assuming all cash inflows and all cash outflows happening at the end of the year, and you're doing it consistently year on year. So therefore, a slight difference in timing of cash flows as a result of a few days, you're not going to have that of an impact. So just keep that in mind. So to bring it to this scenario, you are paying your labor monthly for the year. But we're not going to have 12 columns over here now for year one. We're only having one column for year one. So the assumption is cash flows that happen throughout the year is assumed to have taken place at the end of the year. So because it's happening at the end, it's assumed to happen at the end of the year, we put it into its respective column. So year one's labor cost takes place in year one. Year two's labor cost takes place in year two. So just keep that in mind. Timing of cash flow is very important. So remember the labor cost, 2 skilled laborers. The labor cost is 2 skilled laborers per machine times 5 machines. Each laborer is getting 25,000 Rand per month. And we know each column is an annual column, so we need to make it an annual labor amount. So we multiply by 12. It is negative because it is a cost. So I'm going to put a negative over here. Thereafter, they're going to get an increase of 6% per annum. And I can just drag that across. Okay. Now we go on. Did I miss something? Yeah, I missed something. I'll come back to that what I missed. The paper bags utilized for the bagging of the cement can be purchased locally at R1.50 per bag in 2021 with a 10% increase year on year. While these bags are not recyclable, okay, we read that. So let's move on. So bags, okay, cement bags. So remember, some students is going to say the number of bags is in year 1, 20 million, in year 2, 21 million, in year 3, 22 million, and in year 4, 23 million. That is not correct. The reason being is we only can bag 20 million. So the number of bags we're going to buy is 20 million, because anything above 20 million is outsourced to someone else. So they will be incurring that bagging cost. So just be aware of that. Okay. So once again, we're not going to buy the bags up front. We buy the bags in the year it is incurred. So in year one, we have 20 million bags. We're going to buy the bags in year one. Okay. So we're going to say 20 million bags, 20 million, 20, 1, 2, 3, 1, 2, 3, multiplied by R1.50. put this inside of brackets. Minus what we know, this is equal to that multiplied by the rate of increase, which is 1 plus 10%, and that is the bag for that year and that year. So remember, so it's based on 20 million bags, as that is what we are bagging. Any excess is outsourced. Okay, so just be aware of that, please. Next, overheads. Here we're going to have overheads, which was in year 1, 600,000. Thereafter, increases by 5%, if I remember correctly. I'll check now, but I think it's 5%. Let me just check. So 600,000 and an increase of 5%. So we see that. And then the last one is working capital. Remember, working capital happens immediately. If they don't tell you when working capital takes place, you assume it happens immediately, which is in year 0. Okay. So this is negative 4 million rand. 1, 2, 3. They told you it gets recouped in year 4. But remember, even if they did not tell you, you must know working capital is incurred immediately and then recouped at the end of the project life, which is in year 4. Okay, so just be aware of that. So like I say, if they don't give you a start date for working capital, you must know it happens in year 0. The reason being is, think about Pick n Pay. If Pick n Pay is in the business of selling groceries, right? For them to sell you groceries, they first need the groceries. Groceries to them is inventory. Inventory is considered working capital. So they'll need working capital. They'll need inventory up front before they can sell you. That is why it takes place in year 0. The only time it does not happen in year 0, if they tell you to put it into year 1. So if they say, dear student, put it into year 1, please do so. Don't put it into year 0. Okay, so just be aware of that. There's one thing I just, one of the lines we missed. So we go right to the top again. I'll highlight it over here. So the 13 million, and then they say ready for use, and they say can be sold for 1 million rand. Okay, so 1.3 million. So at the end of the useful life, we can sell the machines for 1.3 million. So over here, I'm just, it doesn't have to be in this order. I'm just putting in this order so that when you go through the scenario, you can see bullet point by bullet point. So this is here, we call it the realizable value. And we recoup it in year 3. So we're making money. So therefore it is positive. It is equal to 1.3 million times there's 5 machines and it's per machine, and that's what we're getting back. So just be aware of that. There's nothing below. So after working capital, we're just talking about the discount rate. So after working capital, we're only talking about the discount rate. So we'll come to that now. So the last line is always tax. I'm not going to deal with tax now. It's going to be a whole separate calculation. That we'll cover in detail. For those of you who have joined the course, it's covered in detail in the course. I'm not going to go through that now. What I will tell you, I'll just put I'll mark in yellow which ones have a tax consequence, but I'll come to that just now. Now we can have that. So now we will have net cash flows. Okay, and we will sum it up. Remember, we must take tax into account. Without tax is not really a true reflection, but we're not going to deal with that now. And then we have the discount rate. Now remember, they said the discount rate must be the 10%, which is the loan specific, the cost, the specific finance, okay, the loan specific finance. But that is not appropriate. The discount rate for capital budgeting is always whack. In the scenario, right at the end, they said CCP's weighted average cost of capital is 12%. Do you see that? Okay, so it is 12%. Now I'm going to work out my NPV. So here, NPC. So remember, it's NPV, but we're just calling it NPC because this is an investment that has costing. If it was something where you took into account the revenues you would also make, then you talk about NPV. But in this case, because we're only working out the costs we're going to incur for this investment, we look at and we call it NPC. That is why everything is negative. Okay, so this was 12%. So I'm going to use the Excel formula called NPV equal NPV. Okay, so Excel wants the rate. Okay, then they want value 1, value 2. So I'm going to skip value. I'm going to skip value 0 for now because they don't take value 0 into account. So it is that, and that. Okay. Then we might just bring in that as well. So the true NPC is the sum. Okay, so the true NPC is the sum of the two. Okay, so just be aware of that. So the true NPC is this 198. Now, this don't tell us much. How do we know we should go ahead with this project or not? Well, we need to compare it to the current contract. So before we can make a decision, we need to compare it to the current contract. So now I'm going to do that. This is going to be like 2 minutes. So remember, based on contract, 20 million. Beyond contract amount. So, the contract is at 3 Rand per bag for 20 million bags. Okay. 3 Rand 75 per bag for bags above the contracted 20 million. Okay, so just be aware of that. So here we just simply say equal to negative 20 million bags, 1, 2, 3, 1, 2, 3 times 3 Rand. That's what the contract says. So each year the contract is 60 million. We know we're going to need some extra. So we must bring in those amounts as well. So in year 1, we're not going to require anything extra. But in year 2, we're going beyond the 20 million per the contract. So we're going to incur that additional 3 Rand 75. What you could have done, because in this scenario, whether you insource or whether you outsource or whether you insource. So just have a look over here. This line and this line is exactly the same. So between the two decisions, it is the same as considered irrelevant. So you don't have to include it. But there's nothing wrong to include it as well. So because I look at a project on individually, you just include it. Okay, so just safer to include it. So just be aware of that. Okay, so I'm just going to highlight it in orange. Now we can get net cash flows. Once again, we're going to use the same rate. Once again, we're going to use the same rate. The rate is the weighted average cost of capital, which is the general cost of finance to the business. So we will use that, okay? So in both projects, you have to use the same WACC. Otherwise, you're not comparing apples with apples. But I just need to add this up, equal sum. So as you can see, if we outsource, it's 198,430. If we insource, it is 198,215. So here you can see that it is cheaper to outsource as opposed to insource. Okay, so it is cheaper to outsource as opposed to insource. However, the difference is really marginal. It is very, very small. So this answer asks you quantitatively advise whether they should outsource or insource. So based on quantitative analysis, you must outsource because outsource is cheaper. The negative is smaller. It is cheaper. C2 talks about qualitative factors. So from a qualitative point of view, you can argue that it's very marginal. And it is maybe from a long-term perspective, it is better for us to have control of our bagging process. So we should rather insource. Okay, that's from a qualitative point of view, but solely based on C.1, which says on a quantitative basis, advise whether they should insource or outsource. So what's your answer going to be? Based on what we have over here, they should outsource. But keep in mind, we're probably going to be able to insource because we did not take tax into account. Tax will have a significant impact on this number, so it'll probably reduce it below the NPC, below the outsourcing answer. Okay, so that is basically how you tackle capital budgeting. Always remind yourself of the principles and make sense of the scenario so that you don't get caught up, especially in terms of that capacity numbers and all of those type of things. Make sure you keep your head above the water all the time. That is from my side, but before we go, do you have any questions? Fakir, you're right on top.
No questions from my side.
Ryan?
No, nothing.
Nasira?
Nothing.
Nasreen? Faid?
Oh, no questions. Are you going to send us the question paper?
I'll send the question paper. I will send the question paper and I will send the Excel. There's a bit of a problem with the video. So for some odd reason, a 2-hour video from Zoom is even too big for YouTube to upload. Other things still uploading. So the first time it failed, I uploaded it again. It's still busy uploading. So hopefully, if YouTube upload it, now I'm gonna let you know. Otherwise, I'm gonna look. I'll see how I can reduce the size. I don't know how, but I'll definitely give you the question paper and I'll send the Excel. So Nasrina, now I have your email address. Nasira, do I have your email address? If you want the solution.
No, you don't have my email address.
You can, what you can do is you can just send me a message in, you can send me a message, just WhatsApp me, not WhatsApp me, chat me privately in this, in Zoom, and then I will send it to you if you want it. Okay.
Okay, thank you.
Okay. Other than that, that's all from me. Thanks, guys. Bye-bye.
Thank you.
All right.
Bye.